All right, everybody. We are going to talk a little bit about chapter 16 and 17 for the next little bit. Chapter 16 was on investments. We talked a little while about investments as far as it being, we talked about land, we talked about marketable securities. We talk about securities, we talk about land, we talk about the investments that we buy in. We keep it at its original cost, right? We keep it at our purchase price, it's our cost. You'll see a whole bunch of, especially when it comes to land, people say, look, we want to go back through and record it at fair market value. Well, the problem, of course, we deal with when it comes to fair market value is that just because one person says it's valued at something doesn't mean that it truly is, and doesn't mean another person will agree. And quite frankly, at the end of the time, the only time you can actually realize a gain, realize that good guy, is when you actually sell it. And to be totally transparent, people will say a lot of things to help make their balance sheet look better. Not necessarily true. I always sometimes, every so often, I'll kind of flip through the TV channels and I'll see the Antique Roadshow. I don't know if many of you all will see it or not. And people traditionally, basically what happened, people will come bring their wares, they'll take it on the show, the guy will look at it, and for the most part they'll tell him, oh, it's worth $10 or $20 or $30,000, some crazy amount of money. And the people get all excited, yay, it's worth $10 or $20 or $30,000. Well, the problem is, though, is that somebody can tell you, hey, it's worth $30,000, but unless somebody is coming and willing to come back around and pay you that $20 or $30,000, it's not really worth that, right? You can't get it out of it because you don't have a way to realize that gain. I mean, it's just a number. It's an imaginary number. I could go on the road show and say, look, your stuff's worth $100 million. People would be excited, right? But ultimately what it kind of comes down to is that nobody will pay it. And that's really, if you think about all the investments, everybody who talks about when it comes to land and art, trying to move it up to fair market value, that's the same logic. I can say anything. That doesn't mean it's going to be true. That doesn't mean it's going to be realistic. Doesn't mean you'll be able to sell the land and get a gain just because somebody said so. So kind of bad stuff. Now, as we kind of go through chapter 16, we're going to talk a lot about investments. We're going to talk about bonds. We've talked previously in other chapters. We, as investors, as companies, we will invest in bonds of other companies, and we will invest in stock of other companies. Bonds, we know, are fixed instruments. That means if I buy a bond from another company, then they will pay me interest, they will pay me principal. These are fixed charges that they guarantee to pay me every quarter, every month, whatever the term is. It's guaranteed income. It's that's basically a fixed debt instrument. And no matter how bad the company does, they still have to end up paying me that amount. So let's pretend that I'm going to go ahead and just buy 50 bonds, $1,000 each for each bond. All I'm going to do is I'm going to debit my debt instrument, debit to a debt instrument, and a credit to cash for the $50,000. That's 50 bonds times $1,000 each. It's a simple journal entry. Now, what will happen is that every quarter, every period of time, I am going to receive interest, right? I'm getting revenue. Since I have bought the bonds of another company, I'm going to get revenue. I'm going to get that interest payment. So in my side of the transaction, I will get a debit to cash because my cash is going up, and a credit to interest revenue. So what I'll have is that I bought the bond. We'll pretend one bond in this case. I'm getting interest income, right? So I'm getting cash. So I have a debit to cash, and I'll have a credit to interest revenue, right? That's my side. The side that sold it to me, right? The other side, the guy who sold it to me, his transaction is going to be a debit to interest expense, credit cash. For my transaction, I'm happy, right? I'm getting cash, thus I'm debiting cash, and I'm also getting that interest revenue. Debit cash, credit interest revenue, life is good. The guy who sold me the bond is going to have a debit to interest expense. It's going to be an expense to him and a credit to cash because he's having to pay out the cash that's now coming into my bank account. So life's kind of good in that case. Now, as you look through chapter pages 693, 694, you're going to talk a little bit about interest receivable versus interest revenue. Interest receivable means that you've recorded the receivable of interest. It just means you haven't been paid yet. What will happen probably a couple of days later, they're going to flip that entry. So, for example, let's just pretend we are, for some unknown reason, we pay, I don't know, I'll make something up real off the top of my head. We're going to record the revenue for a period of time, and it's me as the company. So I'm going to have a debit to my interest receivable, and I'll make up the number $1,000. And I will have a credit to interest revenue. Now that means I have recorded the receivable. I have that asset. I know I'm going to be paid, but I have not yet been paid cash, right? Because we know a receivable is like an IOU. That's what really a receivable is. So I'm going to have a debit to interest receivable and a credit to interest revenue. Now, let's pretend they're going to pay me now, a day later, right? Because sometimes it all depends on when we run our bond. You know, we basically run our payables. We'll pretend the very next day they decide to pay me. They're going to pay me cash. At that point in time, they're going to give me cash, so I will have a debit cash and a credit to interest receivable. So my initial entry was before they paid me. We'll pretend it happened at the end of the month and they didn't want to cut a check until January 1st, whatever the reason. My entry will be a debit to interest receivable because it is an asset to me, it's receivable, and a credit to interest revenue. The following day, or whatever day they actually will pay out the interest, what's going to happen? I will get a debit. I will get a cash, so I will record a debit to cash and a credit to interest receivable. So my two receivables net out, and my ultimate journal entry will be a, netting out, right? Will be a debit to cash and a credit to, interest revenue. Happens a lot. Just kind of we flip through on page 695. Let's look at ownership. It's explain how to account for stock investments. The big thing to keep in mind, this is, we're still a Principles 2 class. Go ahead and read through this. You will not have any of these more complex calculations, at least in this class. If you go on to accounting, which I hope most of you do, you'll end up getting more and more into these, somewhat more complicated transactions. But for this class, let's just kind of know what they are. If you have ownership of less than 20% of a company, it's basically classified as an insignificant influence. If you have 20% or less, the belief is you have insignificant influence on the company. You treat it as a cost method. So as long as you have less than 20%, they're going to pretend you have insignificant control. That's fine. If you have between 20 and 50%, they classify that you have significant control. What that means, if you think about it, right? It means I can appoint people to the board of directors. I can fire people. I can really put a lot of pressure on the management team and really push them into a route that I want. The more pressure the more ownership of a company I have, the more significant in ownership I have, more control that I have inside of it. And of course, what that means, for the most part, I'm going to have more than likely the government's going to be watching me to make sure that I'm not doing anything illegal or, trying to infringe upon anybody's rights. But between 20 and 50% ownership, it's classified as a significant influence, and the reason is, well, exactly that, right? I can put significant pressure on the board of directors. I can put my people on the board of directors who, who share my vision. I can push out the CEO. I can push, really, honestly, if I have that much control over a company, I can push people out without any trouble at all. And if you have more than 50%, that means you have controlling interest. You think about 100%. If somebody has 50-50, I own 50%, you own 50%, that means we're exactly equal partners. If you disagree on something that I want to do and I take the other route, we can't agree, well, nobody will ever win because you have 50%, I have 50%. You know, there's no way to go, right? There's no way for any one person, you or me, to win, right? Because there's no controlling interest. But if one person has 51% or more of a business, 50 and above, right? Once I have that 51%, you can have 49%, I can have 51%, but as soon as I have 51%, that means I can do pretty much anything that I want to. I have controlling interest. You might have 49, I might have to pay you dividends, I might have to smile and listen to you and whatever you want to do, but I have controlling interest. I do basically whatever I want to. And that's one of the good things about having controlling interest, because it's control. That's exactly what it is. Turn to 696. You know, very similar. Let's go ahead and pretend we're buying some stock. Our journal entry is simple. It's going to be a debit to stock investments. That's going to be the number of shares multiplied by your share price, how much you're paying for the stock at, and a credit to cash. If you get dividends that you are receiving in the dividends, exactly what we said before, you're going to have a debit to cash because your cash is going in, and a credit to dividend revenue. Makes perfect sense. If I sell a stock, now here's when the more fun stuff. When I sell a stock, I can sell it for a gain, I can sell it for a loss. It all depends, right? Depends on if I sell the stock for more than what I paid for it initially, I got a gain. Flip side, if I sell it for less, well, I got a loss. So if we have a loss, what we're going to see, we're going to have a debit to cash. We're going to have a debit to loss on the sale of stock, and then we'll have a credit to the stock investment. That's a loss. If I have a gain, I will have a debit to cash, I will have a credit to stock investment, and I'll have a credit to a gain on sale of stock investments. That's, you know, as far as the gain or the loss, it really is, it just depends, you know. So remember, if I'm recording the sale of a stock and I'm selling a stock for a loss, right? The journal entry will be a debit to cash, a debit to loss on sale of stock, and a credit to stock investments. If I am a gain, it will be a debit to cash, a credit to stock investments, and a credit to gain on sale of stock investments. The book does really good on page 696. Just kind of want to go over it just with you together. Short-term investments, just kind of want to read through that. You know, we talk about short-term investments. It can be anything. Really, the goal of short-term investments is I'm going to be able to make some quick money. I invest in a stock market where I see the stock is down. Traditionally, over the past, let's say, call it month and a half, I would invest in Amazon. Amazon was $1,000 per share. It dropped $30 in one day. I would buy Amazon, and it would go up $20, so I'd make a quick $20 a share. I would do that again and again. Unfortunately, now what's happened is that the Amazon was $1,000 a share. It dropped $20. It dropped $30. Dropped $20. Dropped $5. It's just not bouncing back like it was. So fortunately, I didn't invest at that point in time. But the whole point of a marketable security is something that we can get in, we can invest in, we can get a very quick, good return, decent return, and get back out of it very quickly. Long-term investments are investments that we plan to hold on to in excess a year. That's really what we're talking about. For a period, your book calls it investments that are not readily marketable or management does not intend to convert into cash within the next year or operating cycle, whichever's longer. So like if it's really going to be the stock that you believe in, it's going to be the asset you believe in. You know, if you're buying a piece of land that you're planning to develop 20 years from now, that's going to be a long-term investment. It could be anything that you really believe in, but you're going to hold on to it. That's really, for the most part, Chapter 16. The homework problems are pretty straightforward. Chapter 17 is cash flow. And we'll talk about cash flow in another video. Okay, bye.